Before we start, this is general advice in nature. Should you wish to take personal advice, please reach out to your advisor. Welcome to Picture Perspective. My name's Jordan Kennedy. Today in the studio, we've got our investment partner, Martin Fowler, to talk all things America and their effect on global economy. Thank you, Martin.
Yeah, thanks, Jordan. Obviously, a lot to digest over the last few months. Has been a really interesting time. I mean, I think we came from a period where back in December when President Trump was elected, I think markets started to rally through January on the expectation that some of the policies that he was going to introduce were going to be positive for growth, and that of course was all based around the premise that he was going to make America great again. I think the whole plan has kind of been made clearer by Scott Bessent, the Treasury Secretary, recently, and it was pretty much about to try and accelerate US growth to 3 to 5% per annum, based on a few simple ideas. One, to cut government spending, 2, to slash red tape, 3, to reshore manufacturing back to the US, 4, to deport illegal immigrants, 5, to raise wages of the average American. So while obviously they'd lose all this labour force, the plan was that by cutting government spending, those people out of work would get new jobs.
Back into work, yep.
And they'd, blue-collar workers in particular, and their wages would rise because there's a limited supply. So, the plan in theory sounded pretty exciting, but of course, what's gone wrong since? I think what's gone wrong since is that the market was anticipating that the tariffs weren't going to be as bad as they eventually expected, or as aggressive.
Yeah.
There was a lot of talk originally about the tariffs being reciprocal in nature, which just simply means that if, as an example, if China imposed a 20% tariff on a US export, they would expect the US to do something similar. But of course, what happened on April 2, which was termed Liberation Day, ended up being more like Demolition Day. And the reason we say that was the tariffs, instead of being reciprocal, they really were designed to wipe out US trade deficits en masse. Yep. And so we saw this very peculiar situation where tariffs were incredibly high, raised the tariff level to levels we hadn't seen since the 1930s. And of course, markets didn't like that. They fell like a rock initially. And so I guess most investors have been grappling to try and understand what all this means, what are the impacts, and so forth. So I think now we're at a situation where we know a little bit more, but of course there's still a huge level of uncertainty.
Long way to go. Yep.
That's right. At this stage, when the thing or the problem with the plan is really the tariffs themselves. So trying to reshore manufacturing back to the US in theory sounds good. But the problem is, it's really, to do that, you have to put in place protection mechanisms. So you're really allocating capital to inefficient resources from countries which had comparative advantages in what they did.
Also time, right? The time to do it.
Absolutely. Like obviously, in places like Vietnam where they might manufacture rubber bands, why would you want to do that in the US when there's no margin to be made on it anyway? And you've got high labour costs, as that's obviously an extreme example. But I guess the point is that when we looked at these tariff announcements, we realised that two things. Tariffs are always, unfortunately, really a loss-loss situation. The reason they are is that if you're a exporter, you either have to absorb effectively the increased in costs that the end consumer needs to pay, or you reduce. So you either absorb the cost or you maintain the cost and recognise that you're probably going to have lower volumes because there's going to be less people buying because it's more expensive.
And margins start to compress, right?
Well, that's it. So either you have lower margins or you effectively, your selling volumes decrease. Either way, it's a loss-loss situation. And if you're an importer, of course, the same rules apply. So the consumers have to pay more. Therefore, they've got less to spend on other goods and services.
Yep.
And so naturally, consumption starts to decline. When consumption, or not necessarily decline, but it'll certainly slow at the best case scenario, and potentially start to contract if they're too much. And of course, once that happens, that also impacts investment decisions. So people will start to invest less, and therefore, growth will gradually slow across the broader economy. So when we looked at the tariffs, we thought, after the tariffs, initially we thought growth might slow from mid twos in the US to probably 1.8 to 2 or thereabouts. But after the December 2 tariffs were announced, they were far worse than we expected. And then sort of on recalibration, based on what we knew at the point in time, we thought it was high likelihood that US would probably end up in recession, and potentially the globe would end up in recession because they were that severe. So what we know about markets in recessions is typically they fall 20 to 30%. Because the market was relatively elevated coming into this sort of period, they've been very buoyant.
Yep.
Equity markets, as you know, for the last couple of years. We thought we couldn't rule out a fall of potentially up to 25 to 40% in a worst case scenario. But of course, there's light at the end of the tunnel, and the light at the end of the tunnel was probably given by the Commerce Secretary, Howard Lutnick, a few weeks ago when he was asked at a show, an interview about how long the tariffs would last, and he said, at least days and weeks, if not months, but didn't actually say they were permanent. And so that was kind of the first indication.
Confidence to everybody.
Yeah, that's the first indication that maybe they're not going to be too bad. Then, of course, we saw equity markets plummet in last week, and then originally that didn't really do much. But when Trump saw the bond market start to react, and we saw 10-year yields, Treasury yields start to spike, they spiked quite heavily. That caused more concern, and I think that's when his team decided to step in, and they announced that 90-day pause. And the reason they did that, of course, is the 10-year yields. A lot of loans in the US are based or priced off that. So if interest rates go up, remember he's lobbied on this platform that he's going to reduce interest rates. He's going to make America good again.
Yep.
And suddenly all we're seeing is everyone's wealth being
dissipated,
destroyed overnight. He's got shares, etc. So he was almost doing the exact opposite. So I think now Trump is really rattled. He's now on the back foot. He realises these policies haven't worked the way he thought they would, and his team haven't got the outcomes they thought. And so I think we're in this very unusual situation of trying to second guess what's going to happen next.
So Martin, how do we talk to our clients? What are we talking to our clients about? Obviously, our phones are sort of running quite hot, and everybody wants to talk, and everybody's got a view. But how do we steer and navigate our clients through this uncertainty?
Yeah, good question, Jordan. Look, it's obviously a really difficult time. I think now's the time to start to stick to your. Now's definitely not the time to change your investment strategy. So, the investment strategies are critical. You can't adjust your strategy midstream. You have to stick to your strategy. So, the only way we can sort of protect clients is by having protection in place already through our asset allocations. So, if you've got a client who's balanced, you might have anywhere between 60 and 70% in growth assets. And obviously, with these tariffs being announced come this December, we reduced our allocations a little bit. But of course, clients are still exposed. Don't get me wrong. But that reduction to reduce those sort of weightings, and also by buying really high quality assets that can withstand downturns. This is not our first rodeo. We've seen a lot of difficult events in the last sort of 30 years. GFC obviously being the main one, where equity markets fell, peak to trough 50%. We now have to build portfolios with, some defence in place. So buying high quality businesses that can withstand downturns, and having, of course, those fixed interest exposures in place as well, like bonds, which, usually, if rates do start to fall, obviously those bond prices can rise and they can offset some of the falls. And of course, if the dollar falls, having those unhedged international positions also provides some downside protection.
And also having the right level of cash as well.
Absolutely.
To mean that you don't have to sell down your portfolio just to fund your living needs, for example, for people in latter stages of retirement or people looking to do things. So having the right balance of cash is one of the diversified asset classes that we talk a lot to clients about. So we're not having to make extreme decisions in order to buy the groceries.
That's exactly right. So you don't want to have to sell assets in a downturn at depressed prices, and that's exactly right. So, if you're a retiree, you might always be wanting to hold, say, 2 years worth of cash. If you spend 100 grand a year, that's 200 grand or whatever it might be in cash, so you don't have to sell assets in a downturn. That's exactly right. So that's certainly one of the obviously strategies we're looking at in terms of trying to protect client monies. But also there's a tremendous opportunity emerging as well. We have to understand that downturns never last forever. President Trump, if we think about where he's at, midterms are going to be in 2 years. He's going to have to turn it around pretty quick. Otherwise, he's going to lose control of Congress because he's just not going to get the votes. So he'd be very aware that his power is in short supply at the moment, and he'll have to, I think, change tack to get the support of the populace again. Yep. And that gives us hope that he will ratchet back these tariffs, because if he doesn't, obviously, as I said, worst case scenario, markets are going to fall further from here. But we're quite optimistic that the opposite will apply. I think we've already seen overnight that he started to wind back the tariffs on tech companies as a result, and products that the likes of Apple, etc., might produce. And I think, obviously, we're still in this 90-day pause period, but I think that gives us hope that, come the end of those 90 days, he might decide that the damage is done. He needs to change tack and be flexible in his policy making, because this, unfortunately, has been an own goal, and it's a pretty bad one too.
Well, thanks, Martin. Obviously, interesting times to navigate with our clients. If you have any issues or concerns, please reach out to one of your advisors. Thanks, Martin. Really appreciate your time.
Thank you, Jordan.